My name's Charlie Gentles. I work on the financial institutions group at Capital One Bank, covering the financial needs of non-bank financial institutions within the consumer space. So essentially everything that touches the consumer, sans resi. Per requirements, I'm supposed to indicate that I am within the commercial bank and not the broader Capital One consumer institution. So really excited to be here. We've got a great group of panelists that are in front of us. As I mentioned, it's just an exceptional time to be in this space. What you're seeing from a technology standpoint, from what a lot of institutions are doing is really just transforming the way that consumers access credit and then the tools that are available to consumers within the space. You know, with that being said, a great group of panelists from a myriad of different asset classes and different thought leaders and thought processes. So I'd start by just going down the line and having everybody introduce themselves, a little bit about their background and the institution that they work for.
I will start. My name is Jessica Evans. I am the Director of Legal, Corporate, and Capital Markets for LendingHONE. LendingHONE, for those who aren't familiar, it's the nation's #1 lender for the fix and flip market. The salespeople would also probably like me to call out there's a new rental product. But previously I was at Funding Circle for just about 4.5 years, helped their business units launch their securitization program, and then prior to that was at a global law firm doing capital markets work as well.
ARMEN, MEYER, Vice President for Public Policy at LendingCLub. We facilitate roughly $1 billion of personal loans per month. We're partnering with a issuing bank, getting the loans in the hands of borrowers to reduce their interest rate on their credit cards as a primary use case. And then, of course, we sell those loans to a lot of people in this room through our marketplace in the form of securities that are more traditional in nature, than also our latest pass-through certificates as well as our leverage certificates. In addition to selling it to a host of institutions, from non-banks to banks, to regulated entities. In my prior life, I was a management consultant at PwC, consulting banks on technology and regulatory issues, and before that I was a regulator, chief of staff of New York's bank regulator, and that's probably enough.
SHIVEN, SHAH, Chief Financial Officer at OPPLOANS. OPPLOANS is a leading financial technology platform that provides credit access to the tens of millions of Americans who are shunned out of the traditional financial banking system. So this is a very timely topic for us, and look forward to talking about it more.
My name is Paul Williams. I lead the finance and capital markets teams at Tally. Tally is a financial automation company. The first product that we've offered is an automated debt manager. We have also recently launched an automated savings product. What does complete financial automation mean for the consumer? In our view, that means that we will do both the financial thinking and the financial work for the consumer in an automated fashion. In my background, I did the same thing at Earnest, a student lender that is now part of Navient, building the finance and capital markets teams, and that's my background.
Great. Well, so more broadly, the goal of today's conversation is really to touch on how these platforms and then holistically FinTech is really expanding the access to capital and then the way that consumers use capital. So with that in mind, I think the first question I'll just start with SHIVEN. What we've seen in your space is a tremendous growth in terms of the capital that's provided to a consumer that may not necessarily qualify for lending opportunities from a more traditional bank, whether it's from a FICO perspective or thin file perspective. So what I really wanted to get a sense from you is how are you guys growing and expanding the access to capital for those broader consumers, and how is technology used to enable that process?
Yeah, thanks. Yeah, so for us, really our goal is to provide access to credit to customers that have no other alternative. So what we do is we really want to create a product that builds, rescues, rehabs, and graduates our customers into more traditional prime scores where they can get sub 36 and much more cheaper cost of financing. So our goal really is to really treat the customers first, and really customer service is what we built the model on. And what we do is when applicants apply to our platform, we will screen them against 15 other prime lenders, and will give them, and not take that loan and not finance them if they get that loan. What we've seen in the market is that 93% of those people that apply actually do not qualify for a traditional loan. So and only 7% qualify. So we end up taking the 93%, and that is our market, which represents a big portion of America. I mean, the real issue here in terms of access to credit is the savings issue in America. I think we look at about 40% of Americans cannot handle a $400 repair. And so without FinTech companies and our issuing bank partners, it's very difficult to serve the market, which is America in general.
Great. So, Armen, you want to jump
No,
in?
go ahead. No, go ahead.
Okay. So, question for you, Armen. Obviously, I think a lot of the folks in here would be interested to get a better understanding of the regulatory landscape that the FinTech world operates in. There's obviously been a lot of press, a lot of conversations over the years, and a lot of evolution as it relates to some of the major topics. So it would be really interesting, especially in your role, to get a better sense of your opinion, in addition to what really are the industry groups that are supporting whether it's the Marketplace Lending Association or others, and what they're really trying to tackle with the regulators.
Sure. Just for a second, I'd like to jump in on something you said, which is I do think that from what I see, you guys have been able to use technology. I think we've been able to use technology, and I think third-party studies have shown that through technology, through the use of non-bureau data, and frankly through the use of a marketplace where you can sell loans to people with different credit criteria and credit interests, you're actually able to help more and more borrowers across a band of creditworthiness. And we've been fortunate, our industry's been studied by the Philadelphia Federal Reserve banks, and what they found is that by bringing these things together, you can actually go lower and lower on FICO, on a borrower's FICO, yet maintain, yet not increase default rates as you are able to lower people's interest rates going down the FICO band. There's been another study recently that came out and said that LendingClub was able to take this information and this data and compete and be at par with the credit card banks and the largest banks in America, and be better than a lot of them, frankly, at lowering the price of credit and also expanding access to credit into areas where bank branches are pulling out. So the Philadelphia Fed has been very eagerly looking at our space and probably expect more out of them. On the question of where we're at on a regulatory landscape, I think probably the most important issue to start with is the Madden versus Midland case. And I'll certainly get to the association that have been involved in that, and certainly Structured Finance Association is one of them. I think, 2015, right, Madden comes out. It is a case against a debt collector, sold a loan from a bank to a debt collector, and the decision finds that, oh wait, if you sell a loan, you, the debt collector, the loan term, once it goes to the debt collector, the loan terms change all of a sudden. Suddenly that loan, which was not usurious before, can now be usurious. That was obviously a big deal then, but Madden has expanded since a couple times. So we probably went to phase 2 of Madden, as people probably know, in 2017, when the question of, is this about having no connection at all to the loan? Is this about a debt collector, which is obviously not the most sympathetic actors in America as perceived by some courts? Or is this bigger? We learned in 2017 that at least one attorney general in Colorado thought it was bigger when he made a Madden claim against some FinTech marketplace platforms and said, actually, we're going to try to treat you like a debt collector, even though there's still a nexus between the loan that was issued by the bank and you, and the economics are shared. We're going to make that legal theory. Now, that case, as everyone knows, is still pending in Colorado court. But then 2019 came, and this is probably the third phase of Madden, and probably the most familiar to people in the room, where suddenly some, predictably, plaintiffs in New York, private plaintiffs, not government plaintiffs this time, said to some of our largest banks in America and their trusts, hey, we think your securities trusts, those are non-banks, Madden should apply to those. Why should the rate that the bank issued at, why should it not become usurious when it goes to a non-bank, given you have borrowers in the various 50 states with different state usury rates? That, of course, has been a very big deal. That those two cases against large institutions are pending right now. And I think that the OCC and the FDIC, the two big regulators in the U.S., were paying attention without a doubt. I think that those two cases really increased the odds and the trouble Madden was causing. And so what we saw was a pretty vociferous response, right? We saw first both regulators say Madden is an abomination. They did that in an amicus curiae brief in bankruptcy court in Colorado. Then less than a month, maybe 6 weeks later, they both issued proposed rulemakings to fix Madden. They're basically saying, hey, Madden court, you misinterpreted our federal statutes in terms of how preemption works. You also didn't consider the 200-year-old valid when made doctrine. So we're going to issue this rulemaking with our powers to interpret the law, and we're going to basically obviate that case. You relied on the wrong law. We are now changing the law to make Madden, to get rid of Madden and restore clearly the valid when made doctrine. A lot of people probably, there are these two lights on us, so I can't see anything out there. I have no idea how many people are in this room, but there are probably a lot of people in the room who were involved in working with the OCC and providing data and advocating for this change. Certainly the Structured Finance Association was, and kudos to Christy Leo, who I know was at the front lines on this, the president of the association. But at this point, I think it's safe to say the regulators are going to finalize the rulemakings, and I would expect that to happen within months, not quarters, because they have the record, they've acted pretty swiftly, and once they do finalize it, I'll bet Q2 sometime, Madden is no longer the dominant law in the Second Circuit. It will be obviated. It will be a final rulemaking that will change the law. And predictably, no one will be surprised that some attorney generals will protect their state interests. This happens all the time. Some consumer groups will probably join. There will be a suit. But I think, don't take my word for it. You've all read the comment letters, or you've read some of the comment letters, and you've seen the law firm memos. The OCC and FDIC have strong powers and deference from the courts to interpret their laws on these topics. So I would expect that there will be some legal challenge, but that they won't get very far.
There's also been some bipartisan legislation that I believe passed the House, but hasn't been brought up in the Senate. Do you view that as a potential solution here as well, or do you think it's more on the regulator front, as you mentioned?
I don't. You know what? I'm going to pivot to the courts in a second, but I'm going to answer your question first, which is, I just don't see this necessary anymore. I think the regulators have done what they're going to do. And it was bipartisan in the House. The Senate didn't move it. The Senate doesn't move much, hasn't moved for years. So I think the regulators understand that and had to act. I do think we're facing an interesting situation where the courts themselves can resolve Madden. I mean, those two court cases in New York, those two courts have a huge opportunity here. I mean, they are in the Second Circuit. They can interpret what Madden was meant to be if they so chose, which was a case about a debt collector where there was no connection whatsoever. So if, for whatever reason, the regulation isn't finalized, there's still two opportunities in New York court to basically say, oh, we are not going to apply this theory to securitization trusts. We are, in fact, going to hold with what Madden was, a case where there was no connection between the non-bank and the bank. And so you can see the courts take that action as well. And there's a reason the FDIC and OCC issued that amicus curiae brief I mentioned in Colorado bankruptcy court, because lo and behold, Madden is also being considered in Colorado state court there, it would be my guess.
One of the really interesting things over the last few years is the evolution of the FinTech space in terms of the new products that you're seeing, new platforms introduced and then existing platforms introduced as well. Whether that's moving into the auto space, obviously a lot of conversation in HELOCs now as well, and then some really creative things that are happening in general, kind of credit card-like type products. And with that in mind, Paul, you guys are doing something that's very unique and interesting, and would love to get an understanding about your product more broadly, and really how you're utilizing your technology to improve overall the consumer's well-being through the automation process that you guys have in place.
Yeah, at a high level, the way we view the evolution of the industry is that there have been a series of waves of innovation in FinTech. The first wave of this was accessing loans online. I think that clearly expanded access and actually probably helped with pricing and fitting the borrower to the loan. The second wave, as we see it, is a series and a range of primarily mobile tools where the consumer is able to do something. They may be able to use a tool to trade stocks for free, or use a budgeting tool or something where they're engaged with the tool. The third wave, as we see it, is something that we're participating in, which is a wave of automation. We think this is very early, but the next step here is having a product or a platform that does something for the consumer, and they do not have to go into a tool and make a decision or choose what is best for them, but instead there is a product that does that for them in an automated fashion.
Great. And I know we've been very focused on the consumer side so far in the panel, but Jess, obviously want to get your 2 cents here, especially as it relates to the access to capital for corporate borrowers. I know the FinTech space is predominantly focused on the consumer side, but we're actually seeing technology firms really broaden the access to capital that's available on the corporate side, and then certainly if you wouldn't mind touching on the multi-property real estate market as well.
Yeah, so thanks, Charlie. I think as consumers, we're very familiar with the many platforms that have emerged to kind of fill the gap for the underserved or unbankable consumer. When I think about FinTech as just using technology to automate financial services, that can really serve to benefit just about any type of borrower, and that's certainly LendingHome's mission. And I noted earlier, LendingHome is the #1 lender in the fix and flip market. So fix and flip, they have many names. It's bridge loans, I've learned, hard money lending. It's really just loans to purchase a property for purpose of rehabbing and reselling. So you can kind of think like HGTV or one of those like really fun renovation shows that everybody loves. So, LendingHome has lent over $5 billion in just 5 years, and I think that's because they've been able to lend at scale in a market that's been previously very fragmented. It's just been a very hyper-local lending market with a lot of borrowers going to quote-unquote country club loans, because you kind of had to know the wealthiest man in the room to get your project funded, or just regional or private, very expensive lenders. So LendingHome's premise is to democratize that process. It's really to ensure that if you're an individual and it's your first time flipping, or a corporate borrower with lots of real estate in your portfolio, you can get your project funded. And it's been successful at that because, like so many of these other platforms, it leverages technology in the right way. So we all kind of leave behind these, digital breadcrumbs as we're going about our day-to-day transactions, and it's able to aggregate that data in a way that allows it to determine very quickly how many properties a borrower or an applicant has bought or sold in its lifetime. It can look at the zip code to determine how properties are faring. It can look at a borrower's business plan and tell you very quickly how viable it is. All of these data points that tell us more or less how reliable is this borrower without being solely reliant on debt service coverage or loan to value ratios that a lot of banks and traditional lenders are relying upon. And a lot of that is because these banks are looking to sell their loans to the government sponsored entities post-origination. And because of that, they are either shying away from the fix and flip market altogether, or when they do it, they're sort of beholden to these really strict underwriting criteria. So because LendingHome doesn't sell their loans to Fannie or Freddie, they kind of have this freedom in underwriting that really widens financial inclusion. So I would say in that way, it's improving access to credit, but also it's lending at scale and standardizing an asset that historically, as I noted, has been fragmented. So if you have a high net worth individual making loans at high interest rates, or small private lending firms that are just kind of figuring out how they want to originate these loans, Wall Street doesn't have a lot of confidence in those originations. And they're also not doing it at scale. So LendingHome has been able to originate just large homogeneous pools of assets in a way that has institutionalized the asset so it can access the securitization markets. Similarly, when I was at Funding Circle, they did the same thing. So they had a specialty finance product, and they leveraged their technology to be able to lend at scale and originate mass volume in order to access the securitization markets. And I mention that because it's just another way of improving access to credit for the borrower. Ultimately, securitizations flood the market with more credit and at a lower cost to the borrower. So, I think the FinTech model, emphasis on the tech, has really enabled access to credit for all types of borrowers, consumer and corporate alike.
Great, and really appreciate you touching on the ABS market, because I think it's just really fundamentally important for these conversations and these businesses. I think what we've seen in the market, over the last 6 years is really a significant evolution in the funding strategy of a lot of FinTech investors. And what you've seen is really strong receptivity from ABS investors, banks, and warehouse providers in the space. Frankly, generally these assets just lend very nicely to the securitization market. Generally short duration, quick pay, easy structures to put in place. So you've seen an evolution. Obviously, LendingClub's a leader on the pass-through side, with pass-through certificates allowing investors to get whole loan style economics on a QSIP basis, which just really promotes secondary trading and promotes liquidity in the product, which has allowed it to scale and garner a lot of new interest from traditional investors that may otherwise not have been able to participate in this asset class. And then, as the platforms have proven out their credit models as well and have shown consistent performance, you've seen some really strong rating agency adoption to the space as well. I know we saw, one of the platforms a couple weeks ago was the second name in the space to receive AAA ratings on their senior tranche, and it's really a testament, I think, to the credit framework and that exists within these models. So, with that in mind, I'll open it up broadly to the folks on the panel, but would like to get a sense of what you're doing as it relates to securitization today in your strategy, and then how does that strategy evolve and change into the future, and will securitization become, if it's not today, or continue to be a fundamental part of your funding strategy? Not sure.
I'm happy
whoever
to
wants
take
to
it
start.
It is becoming, I think, just a few years ago, securitization was maybe 15% of our funding mix. And I would say now it's significantly higher than that, not just because of the traditional securitizations, but really because of what you mentioned about some of the innovation that people taking a great interest in across the investor spectrum in the club certs, which are the pass-through securities, basically QSUP on some whole loans, to bring more investors into the system. But also the latest is the leverage cert, which allows for more risk appetites to be involved and have that QSIP to be to more easily invest in the loans. And we have found that is enormously helpful to our borrowers, since we are talking about transforming consumers' access to credit. Without the ability to have a broad marketplace, you either got to keep them on your balance sheet, and that is not, obviously, that inhibits growth, and there's probably too much risk for any one entity to do, or you can't make the loan. And being able to figure out ways of diversifying investment is an important part of borrowers' credit health, and another reason why the Madden fix is so important.
Yeah, so from our perspective, we've been fortunate enough to have several lenders come into the space from a bank warehouse facility standpoint. We have not yet done securitization, but I think, and the reason for that really is more of an education process, that not all plus 36% lenders are the same. And I think as we go into the year and the mission that we're trying to accomplish and really solve this issue of access to credit will resonate with the rating agencies and with investors. And I really see us just a few months away from being able to access the ABS markets.
Yeah. For us, the ABS channel is an aspiration at this point. Today we have on-balance sheet credit facilities in a whole loan program, but clearly the deepest market, best cost of funds is the ABS market. In the pursuit of providing better access to credit to the consumer, that's something that we will look to access over time. That's not an immediate project for us, but in the future.
Yeah, I can.
You kind of already touched on it.
Yeah, I can briefly touch on it. Both Funding Circle and LendingHome, I think, historically relied on forward flow investments. They were a true, I would say, marketplace in the sense that they would kind of connect the investor with the borrower. So that obviously is it's just a more expensive way of functioning, and ever since we've been able to kind of like reach critical mass and educate the rating agencies, or in LendingHome's case, which they're unrated, they just have strong enough interest in the market. They've both been able to enter the market 3x oversubscribed multiple times. So I think there's definitely the demand out there, and because of that, it's definitely like our go-to funding strategy at this point. Yeah.
Great. Yeah, I mean, I'm sure most of the folks in here are certainly well aware of how well the platforms are executing trades in the securitization space today, and the adoption from investors. And what I found really interesting is when you talk to investors in the space, a few years ago, you'd see more traditional hedge funds operating throughout the stack, and just given some of the consistency of the platforms, the adoption of the rating agencies, really the strong credit background and the use of technology, you're seeing more of the sticky money folks starting to really support the asset class, whether it's in insurance or asset managers on a senior perspective. And as platforms continue to scale and continue to show significant strength from a credit perspective, I think that will continue to grow. And it's definitely, despite the successes over the last several years within the asset class, more generally, there's still a long way to go. I think most folks would say that we're in the early innings. And with that in mind, I think it'd be really interesting to get everyone's opinion on, if we had this panel 5 years from today, what would be the hot topics? What would we be discussing? Where would FinTech be? Where we evolved, if we're sitting in, what would that be, 2025?
Well, Money 2020 would have to change its name by then, first and foremost. So I think actually our intros would have been longer if this were 5 years from now, because I think the future will be, if we're really serious about financial health, we're spending all this money attracting borrowers, a lending club, we call them members. We got to think of ways to offer them more ways to improve their financial lives. And one way is the personal loan savings, below 36% APR way to get out of expensive credit card debt. But there are other ways, as we're hearing on this panel. And so we're looking pretty seriously at partnerships, new products. We have a small business line. We worked a lot with Funding Circle on that back in the day. We still work with Funding Circle on small business lending today, actually. But we're really looking into auto as a prime example of it. I mean, if the way you were able to save people money in personal loans was solving the market failure, that really that product, a responsible long-term 3 to 5 year loan, was kind of left for dead by the banks once the credit cards kind of took over the market post some Supreme Court decisions. And we solved that market failure by partnering with the bank and creating a national platform to compete nationally, not in a state-by-state way, and frankly, get better at using data. A similar approach is going to be in other markets. So for us, we think auto is an obvious one where you can use technology not just to do some things I just said, but also to secure a car. To as you have members who need help with their credit cards, they're going to need help with other things. And by the way, that market is ripe for disruption. Why? Because a lot of the lending there, you thought credit cards had some problems from a financial health perspective, although they're pretty good, but they have some problems. Auto loans at the dealer, where you're getting a huge premium, often has even larger problems from a financial health perspective. So I think we'll have longer intros. You'll see rates coming down over time. You'll see more people below 36%, wishing you guys a lot of luck in the mission to bring rates down and help people. That's my view.
Yeah, I think my view is that I think in 5 years, I would like to see more partnerships, right, with traditional providers of capital and FinTech companies. I think that there's a good marriage of both worlds where FinTech companies like ourselves try to really use technology to improve the customer experience, really reduce the friction in the application process, the time to funding, the cost of acquisition, and then if we can marry that with lower cost of financing, we can get to a point where rates can continue to be driven down, and that goes to the benefit of the consumer and allows them to continue to improve their credit scores over time. So that's kind of the dream of mine, is if we can get there at some point.
Do you want to?
Yeah, I don't know. I've heard a lot of predictions over time. Like when I started, I remember everybody thought that, the banks were going to die. And then later it was like, well, no, the banks are going to eat up all the startups. And I think that FinTech is definitely like here to stay. It's just like how it's gonna look in 5 years. And I actually think it's gonna become a lot more ubiquitous. I think, you know, it's a very tough industry to enter. There's a lot of legal and regulatory considerations. There's a lot of risk management frameworks you have to navigate. But I guess so in that sense, I'm not surprised by like there's less VC-backed entrance into the market, but I still think it's like a very fertile investment market in the sense that there's all these fintechs that are starting up that have figured out a way, and even banks really that have figured out a way to aggregate these finance as a service, or basically the services that these platforms or that any company needs to have a fintech product, and offer it as finance as a service. And with that, I think it kind of opens it up for lots of companies to have sort of fintech embedded into it and in the background, and there's going to be less of this like one-on-one relationship with like the lender and the borrower. For instance, like I guess just anecdotally, I use an iPhone, so I use Apple Pay wherever I can because it's simple and I can tap in and tap out. And because of that, they have all of my transaction and payment history. If I then want to go on some kind of payment plan for one of their very pricey products, they can very quickly underwrite me and cost effectively underwrite me. And they want to keep, and I think like Amazon, Facebook, they all have like very sticky customer bases, and they probably want to keep these customers in their hub. And in order to do that, they kind of need to have, you know, fintech in their vertical and sort of embedded into their platform. So I think that's really where the future of fintech is sort of headed.
Well, for Tally, the mission of the company is to make people less stressed and better off financially. That was a mission that really spoke to me when I was joining the company. It's clearly a very expansive statement, and there's a lot of runway to cover between here and there. I think in 5 years, I would sort of repeat what I said earlier, which is that we see increasing automation across products. That could be making it easier to access other types of borrowing through the same platform. It could be easier payments infrastructure, or people becoming more comfortable with sharing data in order to get access to better products. But I think overall we do see a trend toward greater automation and greater ease of use for the consumer.
Yeah, I mean, I think these are all really powerful, you know, concepts that, you know, fintech still have a long way to go and to help the borrower. And, you know, ultimately the goal would be to lower the costs, you know, of capital that's afforded to the consumer. And, you know, what I think is really promising about the space is if you think about traditional brick and mortar lending institutions, the, you know, more manual underwriting processes and servicing and just frankly cost structure and overhead, it is significant. You know, today I think the fintech businesses still have a long way to go in terms of continuing to, you know, iterate and change and improve on their business model from a credit perspective. But, you know, if those losses continue to decline and come in line and be competitive with, you know, more traditional brick and mortar businesses, if you think about profitability for these companies, it's going to be compelling when you can automate your, you know, first of all, the consumer wants instant decisions, right? You know, the days of going to your downtown bank and sitting in front of your banker, putting your suit and tie on and asking for a $5,000 loan, you know, frankly are you know, way in the past. And, you know, the ability that the consumer can jump on their iPhone and request a loan and have a decision made within a few seconds is really compelling. And then in addition to that, just think about, you know, the cost savings that are associated with that in the background. So I think there's a really compelling future here that, you know, some of these businesses can be highly profitable if they continue to operate, you know, within the realm. So that's what I'm really excited to see, is in addition to continued innovation, to see, you know, these businesses, you know, adjust costs and move into profitability in the long run.
And there's probably one more point, which is like we kind of live in this bank, non-bank world, and it is coming together a little bit, but 5 years from now, I think we're going to be talking less about bank and non-bank, and it's going to be how your product's in the banking system and how it's a bank-created product, and how you're regulated, not if you're regulated, and more standardization and understanding of third-party providers to banks than there is today, more standardization of what open banking is and who owns the data, more standardization of how you can use artificial intelligence to bring prices down for borrowers by doing better credit underwriting. We have and Madden will be finalized. We won't be talking about that. Got to throw that in. But I think it's going to be a pretty different conversation in 5 years. I share your concern about predictions. The nice thing about them is if I'm right, I'll repeat it, and if I'm wrong, I won't remember, so it's fine.
Well, great. So another question more broadly for the panel, for whoever wants to jump in. But, it's interesting, if we rewind, several years ago, a lot of the predictions were that you would see a lot of consolidation in M&A in the space. I know, Jess, you mentioned that there's obviously, we haven't seen a lot of new entrants from a VC perspective, but, the existing winners and folks that have proven their business models, are continuing to exist in the same, framework that they did, 4 years ago. So, based on rewinding a few years and hearing a lot of the predictions was that consolidation and M&A opportunities would exist. Do you guys feel that that is now your fast-forward prediction still for the next few years?
I don't have that view. I think that companies that are doing something that is too similar to how the world currently operates have a Me Too offering, and incumbents can simply just offer that. And on the other hand, companies that are doing something new and different and where there's real traction will stay independent. So and grow. I don't see M&A as a significant factor for the category.
I actually take an opposite view. I think M&A will be a key part of the story in access to credit. I think, as I mentioned before, I think that there are pockets of strength with capital providers and pockets of strength with FinTech companies that, if put together in the right way, can really drive value creation for the consumer in the long run. So I think that there'll be a point where we will come to realization that that's what needs to happen to be able to get our products to a point where consumers can access it at a very cheap rate.
I don't know if I have a great answer for this. I think I think that there will be a lot of partnerships in terms of realizing sort of the synergies between all of these various FinTech companies. But I also think, we haven't really seen a full cycle, and when we do, you'll kind of see who's well capitalized and who's not, and in that case, maybe you'll see some M&A and consolidation, but predictions, so.
I mean, it's really interesting that you mentioned partnerships, because that's an area of evolution in the last few years that you're really seeing. Several of these platforms have started to announce more software as service businesses, and it's interesting that traditional banks may be the right partner in that aspect. So as you mentioned in the lead-in, that it was 6 years ago it was FinTech is going to end the bank as you know it, and now the evolution is a bit of potentially we should exist in the same environment and can help each other, and with that, whether that's utilizing the FinTech's technology, which frankly has just been far superior to what traditional banks have seen, although they're bridging that gap quickly, or which would be remiss if we didn't talk to Armen about the big news out of LendingClub from last week with the announcement of the Radius acquisition, or in that realm potentially becoming a bank. So, I think the folks I'm sure out here would love to get your sense, of the acquisition, the strategic rationale, and then what it means more broadly for the space as well.
Sure. Well, I think before I get to LendingClub, there's clearly been a debate in the industry for years. So not a filibuster, but I think it's worth a minute of how the whole industry got here, which is, you can tell I'm a public policy guy, I use the word filibuster. No one uses that. What am I saying? No one uses that word. So you had this big debate, right? The OCC said, hey, we want FinTech lenders, we want marketplace lenders in the banking system. We're going to create the FinTech charter. Everyone remembers, talk about predictions. I think we would have predicted 5 years ago we'd all have a FinTech charter. So we know how that story ended. The states did their thing, set over our dead body. Most of the states did not do so well in that. The Conference State Banking Supervisors case did not did not produce the result they wanted. However, the New York case, the New York DFS case, my former agency did, and now the charter is in kind of legal limbo. We've also seen, hey, I got a clever idea, I'll get an ILC. It's just the industrial loan company. Most of them are based in Utah. There aren't many of those charters out there. The FDIC hasn't given one of those in 15 years. And so we saw some FinTech say, we're going to de novo get a ILC charter, and you kind of saw a little bit of a similar thing. You saw the FinTech charter from the OCC, which was over my dead body by consumer groups, by banking associations. Frankly, the Community Bank Association was not pleased when there was an announcement a few years ago. I think BPI actually, just a couple days ago, issued an op-ed saying, we're not really in favor of this ILC charter idea, which essentially, for folks in the room, many would view as a little bit of regulation light compared to a full bank charter, which we will get to in a second. Because of there's no holding company being supervised by a regulator. You're just focusing on the industrial loan company within the broader structure. Therefore, you only have FDIC supervision as opposed to the full panoply of the lovely 3 federal regulators. And so then, everyone then said those was kind of 2 walls that, some were pursuing obviously still, but they're not quite as nice looking as they used to be. And so then you have to ask yourself, why not just embrace, if you're already in the banking system, you're already partnering with a bank, that bank is already making you comply with every law in the banking framework. You're already essentially regulated by the state regulator through your state bank you're partnered with, in our case, Web Bank. So we're already regulated by Utah. We're already regulated by the FDIC through that as a third-party service provider. And by the way, we sell a lot of loans to OCC banks and Federal Reserve regulated banks. And so we're kind of regulated by the OCC and the Federal Reserve as well, because we're third-party providers to the people we sell our loans to. So then you have to ask yourself, why not just be a bank at this point? And so we went on that journey, did a lot of thinking, and so then it comes down to the buy and build decision. And I think the advice, this is not rocket science. If you can buy something that has what you want and doesn't have too much of what you don't want, and does something really well that you haven't done before, and you don't have to pay too much, and it's for sale, buy it. Otherwise, you got to build it. And frankly, it's quite a search. If we're making prediction, I don't predict that there's going to be all these acquisitions of banks, because there aren't that many that will fit a FinTech's need, frankly, and they're not all for sale. Believe me, we know. And so Radius was actually great. I mean, Radius was, in our view, a great partner. We got to know them through talking about partnering. I don't know if there's anyone Radius in the room. We like the culture. We love the leaning in on tech. They're award-winning in terms of their deposit-taking ability, which is frankly where we wanted to complement our strength in lending. They don't have branches. There's not a whole lot of legacy stuff that doesn't fit with what we're trying to do, but that will cause us to be unfocused. So Radius, we're really excited about. They also are very tech-enabled today and already have tech partners, Brex being one, NerdWallet being another. So their infrastructure and ability to be plug and play was pretty impressive to us. So we are really looking forward to completing the acquisition. We have about a 12 to 15-month time frame working with the regulators. They will all be involved. This is an acquisition that involves all the regulators. And we're cautiously optimistic. We think they know the story. We're going to have to do some work and get there, but at least compliance-wise, we feel pretty good given our background and where we've been the last 10, 12 years. This is a pretty logical next step for us. Advantages, why? Like, what do you get out of doing it? I mean, you get, you get some of that. So we talked about regulatory, the regulatory framework. It's a traditional bank framework. I think it makes some people in this room probably more comfortable to buy loans from a traditional banking framework, A. But B, most importantly, on financial health, how can you say to someone where your health is first when you can't offer them a way of actually achieving the savings you want them to achieve? And certainly you can partner that way, and we've looked at that. But it became pretty clear to us that if we're going to save you all this money on credit card debt, we're going to save you all this money on your auto loan, we're going to do good for you on a small business product, we better have a place for you to save some of that money and think of innovative products to help you make more money in your savings accounts, to help you transact differently, and we'll have more to say about it in the future. And then there's more stability. We're with a deposit base. we can be a little more stable, and frankly, we can capture more of the value that we currently can't capture in our offering by not needing to share profits with a partner bank on our loan originations, not needing to fund loans that are on our balance sheet for a period of time so we can sell it to you all in securitizations. We don't necessarily need as many warehouse lines for that if we have deposits. I could probably go on for a while on all the benefits, but I'll probably put it right there and stop.
Great, well, really appreciate it. It certainly is definitely the talk of the town in terms of the big news right before the conference out here. But so it looks like we've got a couple minutes, probably have time for one or two questions to the extent anyone has one. Don't be shy. Yes.
Yeah, so, I mean, I've heard you talk now, Bill, you say that securitization is an aspiration for most of you all. That, the dollars I heard were fairly small in terms of the amount of this being done. And even then, so the question is, where are you going off your balance sheet? I mean, when these loans are made, who ends up holding them? And if it ends up being a bank, isn't a bank going to run it through their own, credit system so that at the end of the day, these are kind of bank loans? And so I guess I'm kind of wondering how much of it is FinTech and, truly FinTech in terms of bringing in new information and, from social media and all the other places. You see it some with personal loans, but it seems like this could end up being fairly traditional underwriting. Just your thoughts on that. So I guess the big question is, where are you going for your funding? And if it is a bank, how much innovation are you adding to the banking business?
Well, so that I can't see where you're looking, but that last part tells me you're talking to me, so great.
But I mean, I know, you're all in the business.
If someone wants to go
So,
ahead.
so more broadly, if we think about how most of these institutions fund themselves, what you'll generally hear is the hybrid funding model, whereby they have both a on-balance sheet and off-balance sheet approach. So most of the institutions have raised equity capital to support building out their technology solutions, but also to invest in their own product. And that's created a strong alignment of interest between their whole loan buyers and then their own balance sheet as well. Where the tech really comes in, and I know we haven't really touched on underwriting specifically on this panel, but if we think about the automation and the digital aspect of the underwriting process, it's an instant decision, and that's just something that doesn't really happen from a traditional banking environment, whereby you log in, you enter your information online, and the full verification process, fraud detection frameworks, which if you dig into a lot of these businesses, what they're doing on fraud is really compelling and interesting. Things like tracking the amount of mouse movements and right angles that are potentially made on the application, which could indicate there's a bot potentially behind the scenes. And those are just things that you don't get from traditional banking. As it relates to the underwriting model itself, these are not FICO scorecards generally, like you may have in a more traditional banking environment. They're using regression or gradient boosting machine algorithms to decision the loans. And if you look at losses from most FinTech players and you cut it by FICO, FICO is just not predictive in the space. And traditionally, at least in my view, the banks have been more FICO-based scoring models, and that's just not what you see in this space, which has allowed folks like OPPLOANS, for example, to give credit to folks that the banks traditionally wouldn't be able to give credit. But let anyone else jump in.
I think for our part, we're actually not innovating significantly as it relates to credit policy and underwriting practices. That is fairly traditional for our platform. Similarly, we're not trying to innovate at all from a regulatory or compliance standpoint. We're trying to be straight down the fairway in that regard. Where we are innovating is in the product and in the experience that the consumer has. So that's where we view ourselves as different, the ability to acquire and keep a customer because of how the product itself and the interface works.
I think that's really important. If you look at the NPS scores, which are net promoter scores, and you compare FinTech players' NPS to banks' NPS, it's exceptionally higher. So the CX, the customer experience in the FinTech has been significantly stronger as reported by the consumer versus their relationship with their bank. So unfortunately, I think we are out of time, but really appreciate everyone coming. Have a great evening. Hopefully everyone has a fun night in Vegas.